good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today, it's no surprise, we're going to take a quick review of the fiscal 2021 budget as presented. Certainly a very interesting budget for pretty much all facets of the economy, including the citizens as well as the investor population. And with respect to the investor population and investment markets, there were some announcements made which could have pretty significant impacts on investor confidence and other factors which will drive values either up or down in the coming years, or in fact months, as we will see quite shortly. So let's just take a quick look at a very summarized look at what would have come out of the fiscal 2021 budget. And firstly, we're looking at revenues and expenditures, as well as that fiscal gap. Revenues are expected to bounce back somewhat surprisingly to $41.4 billion, which would be a roughly 21% increase from the expected $34.1 billion, which is going to be recorded for the recently concluded fiscal 2020. And of course, that would be a multi-year low. Expenditure, no surprises here, fairly sticky, as would have been guided by the Honorable Minister of Finance, as well as others in the weeks coming up to the budget. And that's expected to be just around $49.6 billion, which is a very modest 2.5% decline from that 50.8 expected in fiscal 2020. And the fiscal gap, which is the difference between expenditure and revenue, is expected to narrow. And again, we use that term relatively, to about $8.2 billion from the $16.8 billion projected in the recently concluded fiscal 2020. Now, the Minister of Finance did not provide any growth projections for the upcoming year. So we took the most recent IMF projection for Trinidad and Tobago in terms of real GDP growth for fiscal 2021, and that's around 2.6%, which should compare favorably if achieved to the negative 6.8% growth, which is expected for the now concluded fiscal 2020. Now, in terms of specific stock measures and overall measures that came out of this budget, well, there are a couple that investors should probably be taking note of. The first is that SME listing incentive, which offered some very generous tax incentives to list for companies, small and medium size enterprises, to list on the Trinidad and Tobago Stock Exchange. In our view, that listing incentives, or those listing incentives, may not stimulate listings in the short term, which means that there may not, in our view, be too many additional opportunities for investors on the SME tier, at least in the coming 12 to 24 months. Vehicle quotas and concessions have been reduced for automotive dealers. Vehicle quotas were introduced, or reduced rather, for used car dealers, and it was noted that new car quotas are also going to be coming for new car dealers, as well as the removal of concessions, all concessions on automobile sales, and for the publicly listed companies that investors would hold. That could have implications for Massey and Answer McCall, two groups with significant automobile dealerships in Trinidad, but Massey to a greater extent across the region. That, however, is the effect of that is yet to be seen, given that not much details would have been provided in terms of the quotas, the quota removals, or quota adjustments rather. And finally, in terms of stock-specific measures, well, tobacco duties were increased, both excise duties for locally manufactured products as well as import duties for common market region, as well as extra-regional imports. And that could mean some challenges for Whitco in terms of increased prices that they would have to pass through to their customers. However, given the fairly inelastic demand and slightly addictive nature of tobacco type products, we see that it may not be as significant an issue for Whitco as probably the initial anticipation would have been. Now, at a wider level, there was certainly quite a lot of talking points for the economy, but these would also have quite significant implications for investors, investor confidence, and consumption. The first positive point would have been that the personal income tax allowance was increased from $72,000 to $84,000 per annum, which means that on average, taxpayers earning more than $7,000 a month would be expected to have an extra roughly $250 a month in spending power. So that's generally good news. However, importantly, for persons earning the other $350,000 of the roughly 600,000 persons in the workforce, earning below that, they would have not much benefit in terms of increased disposable income. However, part of the fuel liberalization measures, which included, among others, a sale of NP-owned gas stations, but more importantly, the move from fixed to floating rate fuel prices could have implications for the wider population in terms of higher costs and potential inflationary pressures in an unregulated market where, compared to our neighbors, for example, in Jamaica and Barbados, fuel prices for super gasoline could be as much as 67% higher on average. And compared to diesel prices in Barbados and Jamaica on average, they are almost twice the cost that we currently pay in Trinidad and Tobago at the pump. Property taxes would also lead to some measure of lower disposable income, though not significant. And very importantly, the utilities tariffs, specifically electricity and water rates, have been said that they would be reviewed, with the very likely outcome being an increase in rates. And again, when we would have done a webinar this Thursday, Bourse would have done a webinar and done some of the research. On average, water rates and power rates tend to be roughly 5 to 5.5 times more than we currently pay. That doesn't necessarily mean that we are going to get to that stage in the first instance with the review of rates. However, it does create and contribute to those potential inflationary pressures, as well as the lower disposable income and higher cost of living factors, which could drive a change in consumption patterns as well as investor sentiment, given that they will have quite significant implications on the overall financial performance, that is, of many of our companies that are publicly listed. So in terms of the economic outlook, given some of these factors, and 5 minutes is pretty short time to summarize all of these things, consumption we expect to be driven to somewhat of a lower level. Corporate earnings we anticipate, given the environment, be a little bit on the lower side. Economic growth we also anticipate to be fairly cool, if not lower. Inflation we expect, or inflationary pressures, Bourse expects to be a little bit on the higher side. Certainly with the fiscal gap, we do expect additional borrowings. No mention was made specifically in terms of drawdowns from the Heritage and Stabilization Fund. However, at 5.7 billion US at the last noted figure, and with a very uncertain revenue outlook, it does remain a readily accessible source for the state to draw down in the event of need. And a key theme that has been coming out, and certainly at our webinar, it was raised significantly: how do investors get access to foreign exchange to invest? Well, we don't anticipate that that's going to become any easier in the current conditions. So foreign exchange availability, specifically as it relates for investment purposes, is certainly going to be, in our view, a little bit on the lower end. So again, that's a very brief summary of what would have taken place and how we view the impact of the fiscal 21 budget on certain investor metrics. For more information, you can give us a call at 226-8773, email us at invest@boursefinancial.com, or check out our Bourse investment website. And more importantly, we had recently concluded last week, Thursday, quite a really detailed webinar. And you should catch it. It's on YouTube as well as on our Bourse investment page. Well, that's it for this week. Have yourselves a wonderful week ahead. This has been the Bourse Report.